Start recording. All right, we're live, boys. We're good. W's. Let's get it. Let's get it. Let's get it. All right, boys. Anything y'all need, man. I told you. You guys want to record it? Cool. Y'all wanted a class? We got it. Let's get it. So I'm going to start slow. We're going to go over all of the basics, okay? We are starting real slow. Appreciate the W's, Brando. W's for you, my boy. All right, so let me start by saying this, okay? Let me start by saying there is a common misconception in the markets, right? That maybe when you first heard of the stock market, you assume that it's random, right? If all of us go and buy Tesla right now, Tesla's gonna go up. If we get a huge group together and we buy Amazon, Amazon's gonna go up, right? There is a misconception in the market that when a group buys a stock, it goes up. When you sell a stock, it goes down. And while that principle may be true, we have to realize that we are not the ones in control, okay? Our little $1,000, even $10,000, even $100,000 trades will not move the market, right? The people who move the market are called smart money, okay? Smart money moves the market, okay? Smart money is banks, institutions who have resources and influence over the market, unlike we do, right? I have a little definition right here. Okay, I'm going to share all this with you guys too at the end of class, so stick around to get this, right? Smart money refers to the capital controlled by institutional investors, right? Like hedge funds and big market players, right? These people have superior knowledge, tools, resources to influence the market, right? They are causing the big moves, right? They are the ones who cause, right? We're little fish, right? They're the big fish, right? And we want to swim alongside of them, right? You never want to swim upstream. You never want to go against the current. You never want to trade against the trend, right? If smart money is moving the markets, we want to trade like smart money. Why would we go against the people who actually move the markets, which is why we trade smart money concepts, right? We trade smart money concepts, and this is what this whole class is about, mastering smart money concepts. So we're going to start real slow, go over how they move the market, where they place their orders, how they place their trades. And that's going to give us a little bit of insight on the strategy and where we can also and additionally place trades to mimic what they do. If they move the market, we want to follow them. And they follow a very strict algorithm, okay? This is what I was getting at, right? It is not random. There is nothing about trading that is random, all right? They follow very strict algorithm that moves the market, and us trading smart money concepts, we could get a kind of a hang of this strategy and the algorithm, and we can use this to our advantage, right? We can use this completely to our advantage to make money, and big banks cause huge monster moves in the market. I mean, let's just look at the market lately. I mean, the market has been completely bullish, right? Ripping to the upside since Trump gave the 90-day pause on tariffs, which was on May 9th. So since, what was it? April 9th. I'm sorry, April 9th. So since then, we've been extremely bullish. And the whole month of March, we've been extremely bearish, right? Whole month of March, we fucking crashed and immediately bounced back. These are monster moves, right? If you catch any of these whole moves, you're fucking a millionaire, like real shit. But the good thing is, we don't need to catch the whole move, right? In order to make money, and how I make $400 to $500 a day in the market, is just by catching small little confident moves. But it's about confidence, and our confidence comes from the confluences and the algorithm and the strategy that I'm about to teach you. Okay, so we all good? We all clear, chat? What we got here? A little 29 piece. Cash, what's good, Cash? What's good, E-Twin? Happy to see you in here. Can you teach me what a liquidity sweep is? No, of course, bro. Come on. What's good, Cash? What's good? Love 30 piece in here. Love to see it. Love to see it. All of us putting in work, guys. It's a random Tuesday, 8 p.m. We're all putting in work. Let's get it, right? So first thing I want to talk about, what are we looking at, right? We are looking at the stock market, okay? It's a market. I want you guys to think about Facebook Marketplace, okay? What do you do on Facebook Marketplace? Well, you literally trade. You can trade, right? But other than trading, you are buying and selling, right? You post items, people sell it, then someone buys it from you, right? If you're selling something, someone's buying it from you. If you're buying something, someone's selling it to you. Think about just an exchange, right? Think about a stock exchange, for example. Notice how all of these words kind of tie into each other. Marketplace, exchange, stock market, right? It is literally as simple as an exchange, okay? We trade contracts, right? And these contracts we can either buy or sell, right? And when we're buying, someone is selling it to us. And when we're selling, guess what? Somebody's buying it from us. Real people. Real people. Every time I place a trade, it's a transaction. It's an exchange. Hence the word stock exchange. When I'm buying, someone's selling it to me. When I'm selling, someone's buying it from me. Does that make sense, chat? All right, nice and simple. Nice and simple, okay? So, this is a visual representation of these buyers and sellers. These candlesticks are a visual representation of how the market moves their money and how they place their trades and where, more importantly, they place their trades. And by they, I'm always talking about smart money, right? The banks, right? Because we are trading smart money concepts. We are trading like the banks since they are the big dogs, right? They the big fish. We want to swim with them, okay? So I'm going to introduce a concept to you guys, right, that you probably already know or may have heard of, right? But we're going to go over in depth, right? This is a beginner's class, okay? We are going to go over, right? We're going to start with liquidity, okay? Because liquidity is the foundation to every single good trade, right? I would say 80 to 90% of the trades I take are based off of liquidity, right? And liquidity is a magnet, right? It is where price is headed towards, right? This is price, okay? Price is these candlesticks. We move up or down, right? When we move up, that means there's buyers. When we move down, right, that means there's sellers, right? Sellers, this is a visual representation of buyers and sellers. That's it, okay? And we can get a hang of when these markets are going to make big moves, right? We really can. And I know if you're a beginner and you've never seen a chart before or candlesticks and you look at this, it looks random as fuck, right? It looks like, okay, we're just going up, we're chopping, we're going down. It looks random. I mean, I agree, right? There's no way to really just hop on here and just kind of analyze the charts for the first time without and really pick up on any types of trends or anything like that. Maybe if you spend some time, you could have, right? If you really give it some time. But I'm here to tell you that there is an algorithm, right? There is a strategic way that these markets and these banks place their orders to cause big moves. And we could get the hang of these orders, like when they place it, and we can catch the same move. So first concept I want to introduce to you guys is liquidity, okay? All right, let's type this out. Make sure you guys have a pen and pencil or a paper, anything, okay? First concept is liquidity / liquidity sweep. Okay, all right. Liquidity, okay, what is liquidity? Okay, all right. So first, what is liquidity, right? Liquidity is resting money / orders, right? When people could place limit orders, buy orders, and these orders are simply floating money, right? Floating money. And when price hits these areas or this order or these money, right? This money, it causes a reaction because now orders are getting filled, okay? So let's talk about it, right? Okay? Where can I find liquidity? Okay? All right, liquidity is found above highs and below lows. So let's look at a quick visual, okay? If we look at ES, okay, this is a chart. This is literally just candlesticks, okay? We have highs and lows, right? Highs and lows should be very easy to identify, right? When we come down and make a move down and up, right? This is our low, right? This is our low. This is our high, right? Very, very simple, easy to identify. So if we're looking at the charts, right? We have lows right here. 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 We got lows right here. We got lows right here. Right? See these lows? It should jump out at you. They should stand out to you on the screen. We got lows here. Right? Lows here. Lows here. Now, what is resting underneath all of these lows? What is right here? What is right here? Right? What is right here? Right? This is all money, right? This is all liquidity, right? Liquidity rests underneath lows and above highs, okay? So now let's look at some highs, right? Real simple. Okay, the market moves up and down. You're just marking out the highs and the lows, right? It should jump out at you, right? Especially on the high time frame. Okay, this is a high, this is a high, this is a high, this is a high. And by definition, right, a high and a low. A high is when price makes a move up and then a move down. Okay, all of these blue candles are up candles and all these white candles are down. So you want to see a blue candle and then a white candle, right? And when we talk about lows, it's just the opposite. You want to see a move down and then a move up. That is by definition a low and a high. So when we have a white candle and then a blue candle, that's a low. Like here, white candle, blue candle. Move down, move up. This is lows. These are highs. Real simple. You should be able to zoom out and they should just jump out at you. We can mark off a couple more, right? We got highs here. All right, highs here, highs here, highs here, right? They should jump out at you, right? So now all of these areas that I just circled, okay, this is all where liquidity lies, okay? Liquidity is resting underneath and or above all of these highs and lows. Now, what this is just orders, okay? You can place a limit order, it's called, or a buy order or a sell order in certain areas. So I could put a limit order right here, and if price comes up and taps this area, taps my limit order, it will automatically fill me into a trade. Okay, so some people have orders up here waiting to get filled into a trade. Okay, people who trade breakouts, right? There are retail traders, right? Not smart money concepts, retail traders. We have highs here. If they see price break above a high, they have limit orders at this high, right? That is where limit orders is. Because think, if the market is breaking through highs, right, they assume we are going higher. Okay, so they have buy orders resting right here. So when price breaks above this high, they are automatically entered into buy positions, expecting price to go higher. Okay, what else is, when I say orders, right? Y'all can't see me, but I'm doing finger quotes. When I say orders, right, I'm also talking about stop losses. Okay, if you guys don't know what a stop loss is, this is a beginner class, so I'm assuming some of us don't, right? A stop loss is meant to protect us. Okay, a stop loss is literally the reason why trading can be your full-time job. It is the reason why this is possible. It is the reason why this is not gambling. So many people think this shit is gambling, and it's not. It's fucking not. I'm tired of people saying that, because a stop loss is basically just an order you could place. It's as simple as dragging a line up or down, right? When I enter a position, right? The green is what I'm targeting, right? So I'm targeting green, and the red is my stop loss, meaning if I enter a trade right here, okay, let's just say it's going in my direction, and then boom, if it hits my stop loss, it immediately takes me out of my trade. So let's just say I put $1,000 into a trade. If I lose that trade, that does not mean I'm losing $1,000, right? It is not roulette. We're not playing blackjack. It's not like you put $1,000 on black and it lands on red. You lost all your damn money. That's gambling, right? That's 50-50. The odds and probabilities in trading are so much higher, right? So if I enter with $1,000 and I get stopped out here, maybe I lost $100, maybe I lost $200, but I'm risking $200 to make 1,000 or to make 500, right? The point is, understand what a stop loss is, all right? I'm sure most of you guys understand what that is. I got black and gray candle. Thank God. All right, so now back to what I was saying. We have limit orders at highs, and we also have stop losses at highs. So I want to literally break down to you the way liquidity sweeps work and why it works, because so many people just know a liquidity sweep as, okay, we just take out a high in reverse, or we take out a low in reverse, right? But they don't understand the actual like mechanics behind it. And I think that this makes your trading so much better. I think when you don't just, some people just know this shit, but some people really understand this shit, right? Really understand why these moves happen. And when you have more information, knowledge is power, guys, right? This stuff is very important. So let me go over to you, right, how some people think. Okay, so boom, right, let's just say this is our chart, okay, and this is our sweep. Okay, by the way, let me just show you guys what an actual liquidity sweep looks like. Okay, a liquidity sweep is when we come and peak just above a high or just below a low and we reverse. Okay, let me show you guys a couple examples just to make this a little bit clearer. Right, let's show you guys some examples, right? So right here we have lows, right? We have a bunch of lows right here. Okay, we want to mark off our lows, and look what the market does. We come down, we sweep the low, right? This is the low, this is the liquidity sweep, right? So notice how we sweep out the low and immediately reverse, right? We immediately go higher, right? Boom, low gets swept, reversal, right? That's literally all this stuff is. Let's find a couple more examples because this stuff happens all damn day. Okay, we have a high right here. Sweep out the high, we go lower. New about design. Fuck around to find it. Right, we have lows here. We sweep out the lows, we go higher. All right, real simple. I'm sure you guys are good on liquidity. This is just a very. I know most of us know what it is, but this is a beginner's class, so we're gonna go over it. All right, we have a high right here. Right, we have a move up and a move down. Okay, so we mark out our high. Why? Because there is liquidity resting above the high. Okay, and the market comes up, we sweep the high, and we reverse. Now, there's one very important note that we have to remember. A sweep is only the candle's wick. Okay, so there is two parts of a candle, right? There are two parts of a candle. The anatomy of a candlestick looks like this. We have the body, we have the wicks, okay? The body is the rectangle, obviously, and the wicks are the line, right? The wicks are basically a visual representation of where price went during this time period, right? So if we're on the hourly, this candlestick takes an hour to form, right? We open here, we close here, right? This is our high, this is our low, and this is an hour of price action, okay? Now, a liquidity sweep is only valid when just the wick takes out the high, okay? Notice how we do not close above the high. The wick, the body of the candle is not above the high. It is just the wick, right? Similarly to the other example we marked out, right? Notice how it is just the wick, right? The wick takes out the low and we reverse, okay? So that is very important to keep in mind. It is just the wick that takes out the high, right? We have a high right here. Right, we mark it off. What does the price do? We come up, we take out the high, boom, immediate reversal. So just already by looking at these confluences, right, and or just liquidity, you should be able to get a hang of this, right? We sweep, we reverse, right? Even on the highest time frame. Let's look at the highest time frame. Okay, we had, look at this giant monster sell-off, right? We had a monster reset. Like this is damn near as much as COVID, right? How could you have predicted that this was going to happen? Well, we have highs up here. Why don't we mark out these highs and see what happens? Okay, well, we know there's liquidity above these highs. Okay, what does price do? We sweep it out to a T, right? Perfectly swept out, and we reverse lower. Okay, so this is a liquidity sweep. Now that you have a visual of it, let's go over why this stuff happens to begin with. Okay, let's go over the actual mechanics of this so we can understand why banks do this, right? Remember, all of these things I'm teaching you guys is the bank's way of moving the market. They move the market through manipulation and through orders, okay? That's it. So everything I'm teaching you is how the banks trade, and now this is how we are going to trade because we want to trade just like the banks, okay? What's good, y'all? 32 piece in here. What's up? Hopefully everybody's good. I am recording this, by the way, so I will post it later tonight, right? So let's talk about the mechanics behind a liquidity sweep, all right? So we understand that this is the high and this is the sweep, right? The sweep is when we come above the high. So this is our original high right here, and this is the sweep, right? Now, the reason we do this is simply to manipulate retail traders, okay? There are two types of traders. We have smart money traders like the banks, like us, right? We trade like smart money concepts like the banks, right? And then we have retail traders. Retail traders, all right, if we actually, I made a chart of this last night for last night's class. Guys, we're having classes every damn night. I don't give a fuck. I'm about to have a class every night this week. I don't give a fuck. I'm so motivated. And, man, I really just want you guys to keep learning, bro. I'm about to have a class tomorrow night, too. Fuck it, right? I'm trying to find the, where was my shit from yesterday? Was this it? Right here. So retail traders, this is the difference, okay? Retail traders react to price. Smart money traders create price, okay? Retail traders use indicators. We use liquidity and market structure, okay? We're going to talk about market structure next, right? And then we're going to piece everything together, guys. This might be like a 2-hour long class, Okay, this is going to be a whole bunch of information. So really lock in. And if you have any questions, I'm not looking at chat this second. So any questions that pop into your head, guys, write it down. Write it down. And at the end, we're going to do a big Q&A. We're going to talk about everything. Make sure we're all on the same page. And then tomorrow, we're going to fucking crush it. Right? Tomorrow, we're going to crush it. And yeah, I'm going to trade the PM tomorrow. All right, like I said, I have a DMV appointment. So retail traders, they trade breakouts, right? And we fade the breakout. Okay, so with that being said, a breakout is simply when price breaks above a level, right? So we have a high here, we break above it. Now retail traders look at this when price is right here, right? Price is like right here, and they say, oh, price is breaking above the high, we must be going higher, right? So what do? Right? They see price break out, they think it's going higher. So what do they enter? Do they enter buy positions or sell positions? Chat, what do we do? What do retail traders enter? If they think the market's going to go higher, they enter buy or sell positions. Which one? Talk to me. If you think it's going to go higher, buy. Beautiful. Thank you, chat. Right? Buy positions. So if they enter buy positions, okay, and they get stopped out, what do you think they have to do? Remember the exchange, right? Remember we talked about a stock exchange. If people are in buy positions and they get stopped out, what do they have to do, chat? What do they have to do? What's good, Ian? Right? If they're in buy positions and they get stopped out, what do they have to do? Let's wait on chat, man. Someone's going to get this shit. I know it. Rebuy, no, close the trade, exit the position. You guys are all right. You're just missing one word. If they want to buy, if they're in buy position, they sell, right? The answer is sell, okay? So if they are in buy positions, the way they exit is by selling, right? It's an exchange, guys. Remember, when we are buying, we exit by selling. When we're selling, we buy back in, right? So it just always remember that, right? If we're in buy positions, you have to get out by selling, right? You sell your position, right? If you're in buys expecting price to go up and we go down and you get stopped out, you're in buy positions, you have to exit by selling, right? Just like that. So keep that in the back of your mind, okay? Now, big banks are creating these moves, and the reason they're creating these moves is because they are using so much capital. They are using hundreds and hundreds of millions of dollars, which is so much money that it creates these moves. Now, the issue with these banks moving all of this money is it is very hard to fill $100 million worth of orders. Now, why is that? Because it's an even exchange, guys. Please remember and please understand that if you are entering a position and if you're trying to get in shorts, if you're trying to get into a sell position, all right, someone has to sell that position to you, right? There is always an exchange, right? So if the market, if the banks wants to short $100 million, let's say $100 million, they're trying to fill $100 million worth of orders, they need somebody willing to exchange that money. If they're trying to sell $100 million worth of orders, they need somebody to buy it from them, right? They need an even exchange. Does that make sense, guys? Does that make sense, right? Just the idea of an even exchange. If the market is trying to fill $100 million worth of sell orders, it's not as easy as, okay, let's press a button and we all get filled, 100 million bucks, here we go, right? It's not that easy because they need someone on the opposite side to exchange with them. Means of a willing exchange. This is a stock exchange. And sometimes, most of the time, 90% of the time, right, it is very, very difficult to get $100 million worth of opposite liquidity, right? Opposing orders, right? Because if they want to fill 100 million, they need someone to give, like, exchange 100 million. So what they do to make sure this is a guarantee, right, is to induce opposing liquidity. Okay, so a liquidity sweep, we're about to go over what a liquidity sweep and how it works, okay? So we see this as a liquidity sweep. We break above the high momentarily, sweep it out just to what? Fucking reverse, right? So how does this work? How does the mechanics behind this work, right? Well, we have to realize that retail traders are entering into buy positions, right? Like we established before. When price breaks above a high, retail traders are in buy positions. So when they do get stopped out, what do they have to do? Like I asked before, they have to sell, right? Now, who do you think they are selling their orders to? Now they are selling to the banks, right? Now the banks have someone willing to make an exchange because they have no choice, right? They manipulated retail traders into thinking price was going to go higher just to push it lower, right? And to fill more of their orders, right? So let's just say it never fills all at once either, guys. It never is just like boom, 100 million filled, right? It fills in increments. So maybe maybe the banks fill a quarter million, right? Boom, a cool quarter, or like 250 million, right? They're trying to fill 100 million. Let's just say boom, they enter 250 million orders get filled, and that's enough to push price down to here. Okay, now what is happening? All the traders in buy positions now got stopped out and they have to sell. Now, once price is here, who do they sell to? Now they sell to the banks. Now the banks have even more liquidity. Now they filled maybe $75 million worth of orders, right? And then, maybe we'll get a pullback, right? Minor scalps, and then finally it will fill the rest of their orders. And we will then be able to fill all $100 million worth of orders, okay? Because we induced opposing liquidity. Do you guys understand that? The concept of buying and selling, and how banks try to manipulate you, not you, because we trade smart money, but retail traders, they try to manipulate them into thinking the market's going to go higher just to stop them out and collect their money, right? Literally, that's all it is, right? A lot of people will see us break above a high, below a low, and think we're continuing in that direction when the whole time it's a liquidity sweep. And so now let's go back to the example and let's make it make sense. So now this is our high right here. Above this high, there's a bunch of maybe buy limits, right? Waiting for price to get hit to enter buy. So as soon as this gets hit, what's happened right here, a bunch of traders, retail traders, are in buy positions. Boom, immediately off rip in buy positions with stops around here. Now we get a move lower, and what happens? They get stopped out. Now they were in buy positions. Now here they have to sell. Who do they sell to? You guys can literally see it in the candlesticks. Boom, they get stopped out. They have to sell. Now the bank has someone willing to make an exchange, and now they can fill all their money. And what happens? As soon as we get stopped out, as soon as they get stopped out, boom, big flush, right? Big move down, because now they have someone willing to exchange, and now the move is officially happening, okay? And then we get a clean reversal, all right? Does that make crystal clear sense to you guys? Does that make sense, chat? Does that make sense to y'all? Just the simple concept of manipulation, right? The banks are manipulating retail traders to induce opposing liquidity to reverse price. I'm going to say it again. Write this down. Banks hunt liquidity to induce opposing liquidity, right? To then reverse price. And that's how the market's moving, right? This is literally how the market moves. And no one can tell me otherwise. This is just facts, right? I'm not trying to make up anything here. This is just facts, right? Sweep liquidity, reverse. Boom, another example right here. We have a low. What happens? We sweep the low and reverse higher, right? Sweep, reverse. We come up, sweep, reverse. Notice how the market is always hunting liquidity, right? What in this point in time right here, the market is just floating around, and boom, we get big downside. If you understand that the market is constantly hunting liquidity, where do you assume price is going? Well, the next draw on liquidity is right here, because this is our low. Boom, we go right to the liquidity sweep. Now we're going higher. Now where do you think price is going? Well, we have our next draw on liquidity right here. Price goes up, right? Takes liquidity. Boom, liquidity sweep lower. Now where are we going? Now the new draw on liquidity is here, right? We have a whole bunch more. We have liquidity here now, right? And the market is hunting all of these lows out. If we hop on the high time frame, look, this low, this low, this low, this low, this low. This was all a big stop loss hunt. And even if we go on the weekly time frame, this big ass recession, even the monthly, this big ass recession that we just recently had was just a liquidity sweep. That's all it was. We're on the weekly time frame. Look, we have weekly lows here. What did we do? Boom, swept out weekly lows, reversed, right? This stuff happens on every time frame because price is fractal, right, guys? Price is fractal, meaning on every time frame these confluences play out. Now, aligning them is a whole nother story. That's more advanced. If you guys are at that part, I have, more stuff dropping very soon for you guys to be able to, master that. That's a little more advanced. Right now, I just want you guys to understand liquidity, right? We swept out a weekly low, and now, boom, immediately Diddy candles to the upside, fucking ripped to the upside. And what do you guys think we're targeting now? Well, now we're in an upside. You guys understand we want liquidity, so we have highs here. We just took out these highs here, right? The market is constantly after liquidity, right? So if that makes sense, right, we will begin to move on. Does anyone have any questions about liquidity? I'm ready to master. So if I see it go lower to that stick, I could buy it to the other stick, right? You want to make sure though, like I said, right? Solid explanation, bro. Thank you. Thank you, right? And Grace, so it's not that easy, right? You want to make sure it's a sweep because when we were at this low right here, right? When we're at this low maybe, right? How do you know we're not going to go down to this low, right? You want to make sure it's a sweep. So it's not like at any single given low, we're just buying it up and at any given high, we're selling. No, we want to make sure it's a sweep. Again, what is a sweep? A sweep is only the wick, right? So notice how this low, the body of this candle closed underneath the low. That's not a sweep. That's a break of structure, which we're going to talk about, right? This is the sweep, right? So you don't want to buy here. You don't want to buy at this low. You want to recognize the sweep, which comes with patience and waiting for confirmation. And once you recognize the sweep, then you could buy it up, right? You want to make sure it's a valid sweep though, because we're not going to literally just sweep out every single low and high. Think about it. If we were literally just to sweep out every single low and high, this would what the market would look like. Okay, we put in a high, right? Sweep the high, sweep the low, sweep the high, sweep the low. Market would just gradually just get bigger and bigger if we just continue to sweep, right? That's not how price moves. We have trends, okay? This is a perfect segue into our next topic. I want to just talk about market structure, okay? Trends. We already established highs and lows, which is good. Very good. Okay, so we have trends. There are two types of trends. There are actually really three, okay? We have uptrends, okay? We have accumulation, which is when the market doesn't have a trend, so it's not really a trend. Okay, and we have a downtrend, right? So the market is either going to be going higher, going lower, or going sideways. Now, we do not want to be trading sideways price action. This is not what we want to trade. Sideways price action will kill us. Okay, anytime it's sideways and accumulating, you want to just step away. Simply put, you never want to trade this, okay? So we're gonna just go ahead and delete this, right? Anytime you see chop, you just want to step away. It's a fact. Now, what makes this an uptrend? What makes this a downtrend? It is the simple pattern of higher highs and higher lows, right? We already established highs and lows, right? We know highs are highs, right? These upside moves, and the lows are here, right? So we have, right? We have a low here. We got a low here. We got a low here, right? These are our lows, and then we got highs, right? We got our high here, got a high here, got a high here, right? So notice how we are putting in consistent higher highs and higher lows. This high is higher than this high. This high is higher than this high. This high is higher than this high. And this low is higher than this low. This low is higher than this low. This is an uptrend and is literally the exact opposite for a downtrend. We are making lower lows and lower highs, right? This high is lower than this high. Same way that this low is lower than this low, right? The market is just trending down. This should be very, very, very simple stuff. I don't even want to spend too much time on it, okay? So you want to be able to identify these market trends, right? You want to be able to sit back and say, okay, are we in an uptrend? Are we in a downtrend? Or are we chopping, right? And from there, we can establish a daily bias, okay? And we're going to get into daily bias in a little bit. We got a lot of ground to cover. First, I want to talk about trends and liquidity, okay? So we all good on trends, guys? We're all good on trends? This guy's market analysis is nice. Yes, sir. Appreciate you. So then we have to wait till the candle close. Correct. Exactly. Always wait for candle closure. Always wait for candle confirmation. Which one happens more? Why not? My fault, Grace. This was 3 minutes. What happens more? Why not? You cannot explain the question one more time. You cannot tell what happens more or not. You'd have to go back in the data and see. Yeah. You gotta just see. This is an awesome class, bro. Thank you. Contract. Yes, sir, man. We're not even halfway done, bro. We got lots of ground to cover, right? Guys, this stuff is very, very possible, right? I just want you guys to know that. This stuff it can be tricky. And if this is your first time ever learning about the market, I know it could sound like a whole new language. Liquidity, fair value gaps, right? Like this stuff sounds like the most insane jargon you ever heard. And I'm aware of that. But we got to just realize that nothing in life comes easy. Nothing in life is handed to us on a silver platter. And if we want this, it's so I'm not going to say it's easy. It's so achievable, but we just got to put the work in, right? So right now we have covered liquidity and trends, right? We understand trends are higher highs and higher lows, and a downtrend is lower lows and lower highs, right? All right, boom. Very, very simple. Now, let's hop on the charts, right? Let's look at some examples. We're always going to draw it out and then look for an example after. Okay. So, when you see the market actually, before we do an example, we're going to cover one more thing because this is going to go hand in hand, okay? So, this is an uptrend. This is an uptrend, right? This is a downtrend. Now, how do we know when the market shifts from an uptrend to a downtrend or vice versa? Because it happens, right? We go up and down. We shift all the time, right? We're in a downtrend here, and then boom, we shift to an uptrend. So at what point do we realize and confirm that the trend has shifted, okay? So this is what we're going to go into next. Then everything is going to start to slowly come together, guys. And I don't want you guys don't need a super, super strong grasp on this. And I don't expect you to have a super strong grasp on this because this stuff isn't easy. But if you guys can walk away from this lesson understanding at least 1% more than you did, 5% more, if you walk away from this lesson with even just a strike of curiosity inside of you, maybe I will tap into the lives. Maybe I will start watching YouTube about trading. Maybe this stuff is possible. This stuff kind of made some sense. That's all I want from you guys, right? I'm not asking you guys to be market wizards right now. I'm just asking you guys to follow along and try to make sense of what I say, even though it's a little difficult, and I understand that, right? Here, today we had a beautiful liquidity sweep. Today I actually made about 20% on a move to the downside just off of a liquidity sweep. Swept the high, reversed. I caught this move lower, and I made $300 today. Very, very nice move. We'll go over that too in a little bit, right? So back to the main task at hand. How do we know when the market is shifting from a downtrend to an uptrend or vice versa? So let's draw it out. Boom, we are in a downtrend. Downtrend, downtrend, right? Lower lows, lower highs. We're trending down. Now, at what point do we shift into an uptrend? Okay? We shift and change trends when we break structure. Okay? So we're going to talk about break of structure, right? Make sure you guys are taking notes, right? Break of structure is going to price reverses or continues. You can use this as a continuation confluence as well, right? Price is either going to reverse or continue. It's only going to go one of two directions, up or down. If we're trending down and we flip higher, that's a reversal. If we keep trending down, that's a continuation. It only is going to go one of two ways, right? So how do we know when price is flipping into an uptrend? Well, a break of structure is a candle closure above the most recent high, okay? So think about liquidity sweeps. What did I say about liquidity sweeps? Liquidity sweeps, no candle closure. There cannot be a candle closure above the high, similar to this, right? Right here, we swept out the high, no candle closure. It was just the wick. This is a sweep. A break of structure is literally just the opposite of a liquidity sweep, right? Literally just the opposite of a sweep. So we have to look at our most previous high. So if we're in a downtrend, we're looking at our most previous high, which is this right here. So we are going to mark off this high. And if price comes up and closes above this high, right? This is a break of structure. This is how you could see the trend has shifted, right? Now, if the candle closes above the most previous high in a downtrend, this is a break to the upside. Now let's look at the opposite example. Let's look at a break to the downside, okay? Let's just say we are trending higher. trending higher. Boom, uptrend, nice moves up, nice diddy candles up, right? Break of structure to the downside is if we close underneath the most previous low, right? So this is our most previous low, this one right here, most previous low. If price comes down and we get candle closure underneath it, we have just shifted into a downtrend. And now you can expect price to go lower, right? So this is break of structure, right? Break of structure is a very, very simple confluence, right? It is simply the continuation or reversal, right? It is when we break above or below the most previous high or low. And this is telling us that price wants to reverse. So let's find a couple examples of this, right? I can't decide if I should stay the same. All right, let's look right here. So let's try to put some stuff together. Let's get a little advanced here. You guys are following along, right? What do we have? We have a sweep. Boom, sweep of lows. And then what? Where is our most recent high? Okay, well, this is our most recent high right here, right? So we mark off our high. And what did we do? Well, now we're aligning different confluences. I'm going to make this red so you know it's a break. It's a break of structure. So we come down and we sweep out lows. Okay, what are we expecting, guys? If we just went over this, a liquidity sweep is a reversal, right? So if we see lows are being swept out, where can we expect price to go? We expect price to go higher. Nice and simple. Lows getting swept, we expect price to go higher. Same way highs get swept, we expect price to go lower. So boom, lows get swept. Now we're thinking to ourselves, cool, I expect price to go higher. What is going to confirm that? A break of structure. So boom, now we closed, this candle closed above this high. Notice how it closed above the high. Now we broke structure. What happened after? Boom. Fucking rip. Boom. Fucking rip. Right? And do you see how we just aligned those two confluences? Right? We aligned liquidity sweep and break of structure because our bias was bullish. Our bias was to the upside. I'm seeing lows get swept out. Right? I want to see upside. I'm seeing a break of structure to the upside. That's very good. Right? We come down, rebalance, boom. Fucking rip. Right? This is exactly what I'm talking about. That's a great example of a break of structure. We can see an example of a liquidity sweep right here. Low got swept. Boom, big move up. Let's find some more examples real quick. We were so damn bearish, goddamn. Right? We're watching price. Let's look at the exact same thing. Let's just start combining liquidity sweep and break of structure. Let's just try to start combining these confluences. And if I'm going too fast at any point, please tell me to shut up and slow down. All right, chat? When it comes to sweep, it's the Wick brother. Yes. Nah, definitely not easy, my boy. All right? When a break of structure happens, can it happen just a break with just a wick? It has to be the body of the candle, Zwelly. Has to be the body of the candle. Has to be the body of the candle closing above the high or below the low. So just like this, right? We are looking at NASDAQ and we are looking at a sweep. Boom, this high right here gets swept out. And if a high gets swept, chat, where do we think we're going? Someone let me know. If a high gets swept, do we expect price to go up or down? Let me know, chat. Let me know. If a high gets swept, do we expect price to go up or down? Come on, chat. Easy question. Down. Oh, shit, damn. It all just fucking spammed in all at once. Say less. Down. Beautiful, right? So I see this high get swept. Now, what is confirmation to me? A break of structure. What do? We sweep the high. We start to get downside. I'm sure there's an entry on the low time frame in here to the downside. And then what? This is our most recent low, right? Move down, move up. This is our low. Boom. We close and we break structure underneath this low. Now, this is even more confirmation. Now, with this in mind, and we know that the market hunts liquidity, where do you think we're going? We just swept out buy side and broke structure to the downside. We understand that the market seeks liquidity. So we have liquidity right here, right? This is a low. We have liquidity right here. This is another low. We have liquidity down here, right? And what happens? All of this gets ran through, right? All of this liquidity and more, right, gets ran through because we are hunting out liquidity, right? Does that make sense, right? We sweep highs, we're expecting downside. We break structure to the downside, and then we just dump to the downside, right? The candlesticks are going to tell you where price wants to go. You don't have to guess. You don't have to gamble. You don't have to make educated, like it is literally in the candlesticks. You guys just need to know what to look for. And a lot of these other mentors out here are just teaching you guys bullshit. They're teaching you guys support and resistance or breakouts. Guys, breakouts are literally a retail trader move, right? Trading breakouts is how you get used as liquidity, because you see price break above a high and you take upside and then we just fucking dump, right? We want to trade like smart money, okay? So, boom, we have covered officially. Does anyone have any questions, by the way, before we continue? Any questions? Right? So far, we covered liquidity, right? We know liquidity is resting above highs and lows, and when it gets taken out, we reverse. Okay? Okay. Let's type everything out. Liquidity sweep is a reversal confluence. Okay? We learned trends, right? Higher highs, or lower lows, right? We talked about break of structure, right? Closure. Right? Break of structure is closure below the most recent low or above the most recent high. This confirms the trend. Okay, this is going to confirm the trend, right? So we have liquidity sweep, trends, break of structure, right? Kind of start piecing this together, how the market is moving, right? The next thing we are going to talk about, right? And am I going too fast, guys? Are we good? Can anyone tell me why I get, whoa. Bo said, is in my psychology. Maybe you risk too much, not just me. Crazy, my last Discord, I was being taught support and resistance. You got scammed, my boy. What if I only want to buy when it's best sweep time and never sell to trade? Would that be profitable or hell no? What if I only want to buy when it's best sweep time? What do you mean? Like only want to catch an upside move instead of downside? What do you mean by that, break a leg? Yeah, I mean, it's up to you. It's just if you have the opportunity to make money to the downside, why would you not sell, right? It's the same thing. It's just a different color button. One is red, one is blue, literally. If we're sweeping highs and there's a good setup and we can make money, guys, trading, you can make money to the downside. You can sell stocks and catch the downside and still make money. So I think that it's best to trade both. Why not, bro? It's more opportunity. It's more money. Everything in the market is the same. Just choose how to break it down and understand it. Exactly. It's just about how, yeah, both. 100% both. 100% both. What's up, Tinterbell? Slimy was good. No, not a dumb question at all, my boy. No such thing as a dumb question. This is a beginner's class, guys. Do not ever feel like you have a dumb. Exactly. Thank you. Right? None of you guys. If you guys think you have a question and you're kind of afraid to say it, just say it, guys. This is literally such a tight family, bro. If y'all ashamed to ask and learn, you'll never make it. 100% being right. This is such a tight family, guys. My goal is not to have a huge fucking Discord. My goal is not to scam you guys or to make this. This is literally just to have a tight circle of people who just want to elevate, right? I want a family. And if you guys aren't lifting each other up, I'm not doing my job right. You guys are all in the same position. We're all the same age. We all have the same goals, and we all just want to make it, guys. We need to help each other out, right? If we stick together and we help each other, we're all going to be making so much money soon, right? But thank you for your question, though, Break a Leg. That was good. Thank you. But asking questions is how I'm able to answer some of your questions. I've never taken a trade yet. Exactly. Right. So we are good night. See you tomorrow. All right, Nicole. Good night. I will catch you tomorrow. Right. So not the last thing. We have some more stuff to do. We're not gonna go over literally everything because we would be here for weeks. I'm not gonna lie. Right. We would be here for weeks. I just want a beginner basic class so you guys can understand these confluences. So when I'm live, whether it's a free class on Monday or whether it's my live trading, you guys can follow along because I have so many people texting me like, hey, what do you mean by fair value gap? And it's like, let's take a step back, man. This is a beginner class. So that leads us into our next topic. We are going to talk about imbalances, okay? Fair value gaps, right? Fair value gaps and liquidity are the two main confluences I use. Okay, I'm going to draw out a little diagram real quick. Give me a second. I am not artistic in the least bit, but I'm going to do my best. Okay, let me just draw these damn wicks. Mira, you're dealing with Mira. Alrighty. So, a fair value gap. Okay, we talked about market structure. All right, this wasn't it. It was mastering smart money concepts, right? We talked about liquidity. I don't really use order blocks too much. I just put it in there just so you guys can take note of it, right? Now we're going on to fair value gaps, okay, slash imbalances, okay? This is liquidity and imbalances are the two main things I use. You really just, to be honest with you, I don't think you even need anything else. Maybe like SMT, but I think you could just trade based off of liquidity and imbalances and like volume, right? So an imbalance, a fair value gap, is a 3 candlestick pattern. Now this is, pay attention guys, because this is where shit really starts to click for most people. As soon as we start covering, trends, liquidity, and we get to fair value gaps, a lot of people have like a aha moment, okay? So a fair value gap is an imbalance left behind due to a lack of buyers or sellers, okay? So in this example, we had a huge move up, meaning the buyers are in control, meaning there is a lack of sellers, okay? So we created an imbalance due to a lack of sellers because there was strictly buyers in the market. Now this imbalance is found in the middle of the 3 candles from wick to wick. So from the first candle's wick to the third candle's wick, this is our fair value gap. Do you guys kind of see how I drew that? From the first candle's wick to the third candle's wick. And the gap is created when the wicks do not touch, okay? Notice how this wick and this wick do not touch. This is the imbalance, right? This imbalance was created because in this price range, there were 0 sellers. No sellers involved, just buyers, right? So what the market will tend to do is, because price has to rebalance, right? We need an equilibrium and price needs to be balanced. You will never ever just see price completely rip up forever or just completely rip down forever. It doesn't happen, right? It doesn't happen. The market moves in waves, right? The market extension, retrace, extension, retrace, extension, maybe we crash and then we build back up again, right? This is how the market moves, right? And on these retraces, right, we are rebalancing 2 fair value gaps, okay? So this gap was created due to no sellers being in the market, just buyers. So what do we have to do? Sellers have to step in, sell off into the gap. Now price has been rebalanced, right? Now we have buyers and sellers in this price range, right? There were just buyers on this move up, then we sold off. Now we have both, and now we can continue in whatever trend we were in, right? So we need to rebalance 2 fair value gaps, right? Let's go over a bearish example real quick. Just bear with me while I draw this shitty ass drawing. Does this make sense so far though, guys? Right? Once I hop on the charts, it's probably going to blow your mind if you don't know anything about trading. All right, this is how the market moves. All right, gotta draw our wicks. Okay, so an imbalance is created when the first candle and the last candle, the wicks don't touch, right? The imbalance is literally the meat of the move, right? The body, right? The body of the candle, the very middle of it, right? So we're marking out the middle from wick to wick, right? Just like that. Now this is our fair value gap, right? Now this gap was created due to a lack of buyers, right? Now we were moving down, so we had straight sellers in the market, right? Boom, straight sellers. So what the market will do is buy back up, right? Buyers will step in and buy back up right into the gap. Now the gap is rebalanced, okay? Now we can continue in whatever trend we were in, right? Now we can continue lower. But I want you guys to notice something about right here and right here. The candles never close below or above the gap. If the candle closes below, that is not what you want to see. That is something different, which we will talk about, right? You want to see if you're expecting price to continue. Let me say this again. If you are expecting price to continue in whatever trend we're in this example, we're in an uptrend. In this example, we're in a downtrend. If you are expecting us to continue in this type of trend, you want to look for a rebalance to this gap, and this is a great place. You could take entries, you could find your bias depending on the time frame, right? But this is how the market moves. Lack of sellers, we sell off, rebalance, continue. Lack of buyers, we buy back up, rebalance to the gap, and continue lower, right? Does this make sense? Do you guys want, if you guys want to take a screenshot of this, take a screenshot. And yeah, this is how fair value gaps work. Are we all clear on this? Respecting the gap. What you write down will stay in your mind. I sometimes feel like it's big sometimes. Yeah, take screenshots. Take screenshots. Does the size of the imbalance matter? No, as long as there's an actual imbalance. Let's go over an example, right? Let's hop on the charts and find an example of an imbalance and something that's not an imbalance, right? Because sometimes there's not always an imbalance. Now, let's look right here. Now we have a good little tip or a little secret to finding fair value gaps easily is simply look for a big move, right? A fair value gap is created by displacement, right? When we displace higher or lower and there's a lack of buyers or a lack of sellers and we rip higher or we rip lower, that's when we typically have gaps. So if I'm not going to look for a gap in here, there's no displacement. We're going sideways. Here, though, we have big displacement up. So from the first candle to the third candle, right? This is our imbalance. What does price do? We come up, we break structure, right? Notice how we close above this high, break structure, pull back to where? Fair value gap. Why? Because we need to rebalance. And then what do? Continue higher to where? The next draw on liquidity, right? And how did we get this move up right here to begin with? Well, guess what? We were delivering out of another fair value gap. We have a fair value gap right here. And what were we doing right here? We rebalanced to another fair value gap right here. So let's go over price right here. We sweep liquidity, boom, we break structure, right? We break structure closing above this high. So boom, sweep of lows, we're expecting upside. Boom, we break structure. Now we gap up, right? Now we're bullish. We, boom, big move up. We expect a rebalance to the gap. We can see price draws right into the gap. Boom, continues higher. Boom, big move up. We sell back off. Why? Because we need to rebalance price. We rebalance to the gap. Boom, we break structure again to the upside. What do? We break structure. We continue higher. Rebalance. We have to rebalance to the gap. Boom, what do we do again? We come up, and now we're sweeping this high, right? And now we're just kind of chilling inside of this fair value gap, right? So do you guys see how this kind of works? Let's find some more examples because this stuff is everywhere. I mean, I can mark off millions of these. What do? We break structure, right? We close above the high. Every single thing I'm teaching you guys right now is all you need. I see so many damn traders complicating the fuck out of trading. It's so unnecessary. You just need to look at the candles. We break structure to the upside. We close above the high. We're in an uptrend. We leave behind a fair value gap. What do? We rebalance to the gap, continue higher. We break structure again. We rebalance again. Now we're sweeping lows. We break structure, rip, rebalance, rip, break structure, rebalance, right? It's the same exact things over and over and over again. Rebalance, never closed underneath. Notice how none of these are closing underneath the gap. This respected the gap. This respected the gap. Right? I could go on and on and on. When Trump released the pause on tariffs, we had a huge shoot up in the market, which gave us this fair value gap right here. And guess what? To this day, still never got invalidated, right? We never closed underneath it. We never got down here. We respected the gap. And guess what? Trump announced tariffs, created a gap. We filled it, rebalanced, and fucking mooned. Boom, skyrocket. To where? The next draws on liquidity. Liquidity here, liquidity here, liquidity here. Now we're just hunting liquidity. Right? Understand how this market moves. It has an algorithm, and if you guys are telling me it doesn't, you guys are tripping. Right? I'm showing you guys the algorithm. This is how the market moves. We sweep lows because we need to manipulate. We reverse, we break structure, we pull back, and we continue. Sweep, break, pull back. Sweep, break, pull back. That's your entry. Right? Obviously, it's not that simple. We need a little bit more confirmation, but we sweep, we break, and we pull back, right? And now that is where you want to look for an entry, right? I could go on all damn day, all right? Look at this fair value gap. Okay, we have a fair value gap right here. Boom, let's mark it out. What do? We respect it. We did not close. Now the wick is above it. That's fine. The wick can do whatever the fuck it wants, but we cannot close above the gap if we're bearish or below the gap if we're bullish, right? Notice how the candle didn't close. We closed right at the gap, but not above it. So we rebalanced, continued lower, all right? Right here. Fair value gap was created. We break structure, create a fair value gap. We rebalance to the gap, continue lower, right? Are you guys starting to see how this stuff works, right? Is this making sense to you guys? So I'm so grateful you aren't speaking gibberish right now. Yes, sir. That means you're understanding, bro. I understand that. Let's fucking go. I'm really thinking about how long it probably took doing it on so efficiently to others. I've been doing this for 3 years, gang. 3 years. Started when I was 18. I'm 21 now. Good shit, bro. Yes, sir. Appreciate that. All right, we're not done, though. Let's keep it going, man. Let's keep it going. Let's get it. Let's get it. Knowledge is power, guys, and knowledge is also money. So, right, let's take care of our brains. Let's take care of ourselves. Let's keep learning, man. So, now we can start to use fair value gaps and liquidity and breaks of structure combined, right? Slowly, not immediately, but slowly, we can get the hang of it. So now, let's talk about this, okay? Let's look at this example right here. We know the market hunts liquidity, but we also know before we can make a move, we have to rebalance. So let's just look at this model, okay? We have liquidity right here, right? Buy side liquidity right here, or sell side, I'm sorry. And we have a fair value gap right there. So now, even though we're super close, I don't want to take an entry down here. I want to wait for the rebalance. Why? Because it has to happen, right? We always rebalance, and the market is going to try to trick you. It's going to come all the way down here, super close to the low, expecting you to get into a short position, and then it's going to rebalance higher, and you're going to get stopped out, right? This is why most people fail, okay? So we're waiting. I want to see this get rebalanced too, and then I will catch the move down to the draw on liquidity. It's that simple, right? So we're waiting. Boom. We rebalance to the gap right here. Right, I'm switching up the time frame now. I'm going to the lower time frame. So now this is literally market open too. This is a perfect example. This is 9:30 market open, the exact times we trade at, right? So now I'm on the 15-minute time frame, okay? We have our draw on liquidity still intact, right? The low was never taken. Also, this low was never taken either, right? Boom. We got 2 draws on liquidity right here. None of them have been taken out yet, so I'm expecting them to get taken out. Why? Because the market hunts liquidity and we're bearish. We're in a downtrend. We're moving lower. Lower lows, lower highs. Lower lows, lower highs. Right? Do you guys see it? Right? Lower lows, lower highs. Lower lows, lower highs. Lower lows, right? We're moving lower. So we are looking for sell side liquidity, or AKA lows, to get taken. But first, we need to rebalance to this gap. So market opens at 9:30 right here. Boom. We rebalance immediately. I'm immediately dropping down to my lower time frames. And I'm looking for an SMT, a break of structure, and waiting for my entry. So we could see we most likely put in an SMT right here. We actually swept out a high, so we mark out our high. Even on the low time frames, guys, this stuff always happens. Price is fractal. Now I'm on the 5-minute. We made a 5-minute high inside of this fair value gap. So now we're sitting inside of an hourly fair value gap, right? Or also a 4-hour gap, right? If we go to the 4-hour, this is a 4-hour gap. The hourly gap is right here, right? From wick to wick, right? This is the hourly gap from wick to wick. We come up and we fill in the hourly gap. We then scale down, right? And now we expect price to go lower. So what do we want to see? Well, I want to see highs get swept out. Remember, a liquidity sweep is a reversal. So if I want price to go lower, I want highs to get swept out. So now I'm seeing, okay, high got swept out inside of this higher time frame fair value gap, right? From there, I'm just simply looking for a break of structure. Boom, we break structure right here. Easy entry. Guys, this is very, very easy place, right? And let's see where price went. We went right to the draws on liquidity, right? Because that's what the market is hunting, right? Liquidity, and we probably even go lower, right? This is what the market does. And it's about timing and understanding what to look for. If you know what to look for, it's easy. We rebalance to this hourly gap. We mark off the fair value gap. We have our liquidity. We're saying, okay, we're in a downtrend. I want lows to get taken out. I'm targeting lows. Okay, at this point in time, right before market open, we had not taken out any lows yet. Look, none of this low wasn't taken, this low isn't taken, but we rebalanced to the gap, which is exactly what I want to see, because we always rebalance. We scale down, we wait for confirmation, and that bitch just goes right to take profit. And this is already 100% on options, 80% on options, and I'm making fucking bank, right? On my normal position size with this, I'm making $600-700, bro. Boom, that easy, because we studied and we knew what to look for, guys. It is that freaking simple, right? We studied and we knew what to look for. So I hope these fair value gaps are starting to make sense to you. Remember, back to what I said before, the market moves in two motions, right? We have extensions and retraces, extensions and retraces, extensions and retraces. And these extensions, the big moves, are always towards some higher time frame draw on liquidity, right? So let's just say we're bullish. Let's just say this is our example. Right, we have a low, boom, we sweep out the low. Right, let's just say this is our example. Oh shit, what the fuck did I just do? Jesus Christ. Right, cool. Let's just say, oh my god, I fucking did it again. Jesus Christ. All right, right, let's just say this is our example. Okay, well, we have buy side liquidity above, right? We swept out a low, right? This low got taken out. We're starting to reverse, okay? Now, every extension, right, the big moves, right, we have extensions and pullbacks. Every extension is always towards liquidity, right, because we're always hunting liquidity, right? So every extension is going to be towards a draw on liquidity, and every retrace is going to be to a fair value gap. So you're able to time your entry so beautifully, right? Boom, we retrace to a fair value gap. Maybe right here, boom, retrace to a fair value gap. Retrace to a fair value gap. And this is where you take your entries, because we know the end destination, right? I always tell my students, guys, you never get into a car and start driving with no destination, right? We always know where the fuck we're going. You should, at least, right? So now we know where we're going. We know we want buy side liquidity. Why? Because, well, we have a sweep at lows. We broke structure above this high. We're respecting bullish order flow, right? We're respecting these fair value gaps. And how do you know when to enter? Well, you don't want to enter up here, because why? Well, if you enter a buy position up here, when we retrace lower, you're going to get stopped out. Let's just say this was your position, right? You enter at the very top right here, targeting this high. Well, we're going to retrace and it's going to stop you out. So you always want to enter at the retrace in the fair value gap. So you identify your draw, you identify the trend, you wait for a retrace to a fair value gap, you put your stop underneath it, and then you target the draw on liquidity. It's very, very, very simple. And this is how the market moves. We're not trading any shitty breakouts that fade and get stopped out. We're not trading retail movements. We are trading like the banks, because the banks are what moves the market. Okay? Now it gets one step deeper. First of all, does this make sense, chat? Do not use the 5 second. That's crazy. Dylan, teach them about breakaway gaps. That's a good sign. I don't want to confuse them. I'll give y'all free sauce. It's just too much right now, Beam. Like you know what I'm saying? It makes sense, but like it's just not necessary right now. Lose daily if they don't notice the fair value. Yeah, retail traders get faked out a lot. That's why they're just mainly good scalpers. Confirmed buy. Isn't the 5 second time frame the best to use? Why 15 minute? Never use the 5 second. You studied 2022 model? Yes, sir. Watched that whole damn thing, simplified it myself. Literally watched that whole damn fucking 2022 mentorship, listened to an old guy yap for fucking 17 hours just to simplify it and teach it to you guys. I'm late as fuck. What did I miss? A whole bunch, my boy. I recorded it, though. I actually recorded this lesson for the first time. So I'm going to post this whole thing if you missed out, please. Don't even trip. Right? Can you repeat why you entered at the retrace? I'm assuming you meant retrace. Yeah. Because, guys, if you enter at the move up, remember, there's move ups and retraces. On this move up, if you enter at the tippity top right here, okay, and your stop loss is right here and you're targeting the high, right? This is a 1 to 2, good risk to reward, right? When we retrace lower to rebalance to a fair value gap, because we have to rebalance, you're going to get stopped out. And then guess what's going to happen? It's going to rebalance, stop you out, and then go right to your fucking take profit, right? That's what's going to happen. And you're going to get manipulated, stopped out just for it to go in your direction. And you're going to be frustrated, and that's going to cause a whirlwind of emotions. Now you're going to overtrade, revenge trade, and then you're going to lose all your money because you're stuck in an unprofitable mindset. You have to know what to look for, execute on your plan, manage your risk, and keep a good psychology. Okay, guys? That is everything we need to do. So this is why we enter down here, right? Because if we enter at the retrace, now we could have a good stop loss and even better risk to reward. It went from a 1 to 2 to like a 1 to 5, right? And we're making more money, right? This is how we maximize our profits, guys. This is exactly how we do it. It is not random. There is nothing about the market that is random. Everything is premeditated, everything is calculated, everything is methodical. Everything. I don't care what anyone says. Even this shit, like, right? Everything is methodical. Everything, everything, everything. Does that make sense, chat? Retrace, all good. Yeah, I'm halfway through that shit right now. Could it? Yeah, I think that E-Money, I wouldn't watch the 2022 mentorship. He just does so much damn yapping, and I'm telling you right now, I listened to it all. I wasted a lot of time. There's definitely some hidden gems, but you don't want to waste your time, bro. It's too much, bro. You want to just simplify it, bro. You definitely want to simplify it because although he has good advice, it's just a lot of bullshit. Not gonna cap. Yes, sir. What's good, Brando? Okay, now shit gets crazy now, right? This is gonna be one of the last confluences we cover, okay? And then we're gonna start to tie it all together, and I'll share the document with y'all. We'll do a little Q&A, and we will call it a class, okay? So, all right, let me see. Do I still have my, okay, beautiful. Remember what I said about the candle closure, okay? We do not want the candle to close underneath the gap because that's not respecting the fair value gap. Now, let's just say we get a move like this. Boom. Candle runs through the fair value gap and we close underneath it. Now, this is something different and we can still use it to our advantage depending on the context, okay? This is called an inverse fair value gap. Now, what this is telling me is the sellers are stronger than the buyers. It is literally flip-flopped. It's opposite. If we respect it, right? If we make a move like this, we respect it, cool, we close inside of it, we're bullish, right? We can look for a continuation. But, however, if price closes like this and we disrespect it, this is telling me sellers are stronger. And we can use this equally to our advantage, right? If we close underneath it, this means sellers are stronger, right? Now let's look at this bearish example. If we have a candle come up, boom, like this, and it's bullish, fucking nice big diddy candle, right? We close right through this gap, boom, immediate inverse. This is telling me that buyers are stronger now, right? Now, this is also a piece of information. Guys, every single thing I'm teaching you, every single thing, I don't care what it is, every single confluence tells you one or two things, right? It's going to tell you price wants to go up or it's going to tell you price wants to go down. That's it. Everything. And if you can correlate that with your bias and overall market context, you're going to print money out of your fucking ass, guys. I'm literally averaging double, more than double what I used to make at my 9 to 5 job. I would work at a pizza place. Guys, I worked at a pizza place for so damn long, grinding my ass off, still trading, still losing money, funding my trading with my pizza place money. I'm still paying bills, trying to help my mom out. And I would lose all my money. And guess what? It was just about just putting my head down and just putting in the work, right? It's just about putting in the work. That's it. There's no excuses. I don't care if you guys are busy. I don't care if you guys have it hard. It's possible, right? Because this stuff is very achievable. It's just about knowing what to look for. So once again, if we have a bullish gap, right? This is a bullish fair value gap because it was created on the way up, right? Bullish means up, bearish means down. So I'll make sure you guys write that down if you don't, right? If I say bullish, I throw around terms like this a lot, like longs, shorts is just another word for saying upside or downside, right? If we're bullish, it's upside. So we have a bullish gap here and it got ran through, it got disrespected. Now, if bullish confluences are disrespected, inherently, that means bearish confluences are being respected, right? Same way this bearish gap got disrespected, so the bullish is being respected, right? We're bullish. So now we can use this to our advantage as well, right? So let's just say let's just say, let me try to find beautiful, right? Let's just say we are looking at this trade right here, okay? We are seeing remember, a liquidity sweep is always step one, right? Step one is always identifying a liquidity sweep. Not always, but most of the time, it's based off of a liquidity sweep. Like I said, liquidity is super, super important, right? So we see, okay, lows being swept out. We know we're expecting a reversal. So if lows are being swept, notice it's just the wick of the candle, not the body, just the wick. If lows are being swept out, we're expecting upside. Now, what is confirmation? How can I get my entry? And how can I use inverses to help me? Well, okay, I'm expecting upside. So let's scale down. We never want to take our entries on the 1 hour. We always use the low time frame. We're always using every time frame. Okay? And if you're still confused about time frames, bro, hit me up. We'll talk over the phone or something. Or I'll send you a good YouTube video. Right? So now, this is the low right here. This is the sweep right here. Right? We are sweeping this low out. Okay? And I am expecting price to go where? Higher, right? I'm expecting price to go higher. I want to see price deliver higher after sweeping out this low, right? Low got swept. I'm expecting to move higher. Now, what can confirmation be to the upside? Well, we have a bearish gap right here, right? This bearish gap was created on this move down. And I promise you guys, on almost every single liquidity sweep on the move down or up, right, towards the liquidity sweep, right? This is the move down that actually swept out the low, right? This is the low right here. This is the low right here, right? This is the low. On the move down that actually took out the low, we almost always leave a fair value gap, right? Almost always. So how can I use inverses to help me with my confluences, my bias, right? I'm expecting price to go up. My bias is higher. I want to see price go higher, right? We have this bearish gap here. Well, what's going to tell me we want to go higher? If we run through this gap and we inverse it, similar to how we did over here. Where did my drawings go? Do I still have my drawings? Damn, that might have got deleted. All right. But similar to the drawing, right? I want to see price go higher. I want confirmation to the upside. So if we run through this gap, that's confirmation that the buyers are stronger, that my idea is playing out. This candle didn't inverse it. This candle didn't inverse it. This candle inversed it, right? This is the candle that's telling me we want to go higher because we closed above the gap, right? This is our box. This is our gap. We closed above it. This is our inverse. This is telling me buyers are now in control. So we break structure. We pull back. This is where you look for your entry. Guys, what did I say? Sweep, break, pullback. Sweep, break, pullback. Sweep, break, pullback. Get it through your head, right? This is our sweep right here. This is our break right here. And then this is our pullback. We sweep, we break, we pull back. Just like that. And I guarantee you we pull back to equilibrium, which is just another thing that I use, right? From lows to highs. Boom, we pull right into equilibrium, which is this 50% discount. Boom. That's your entry. Immediately what happens? Let's just say you enter right here. Immediately you enter longs at equilibrium. Cool. What are you targeting? Well, you're targeting liquidity, right? Okay, well, we have a high right here. This could be TP1, right? Immediately in seconds, TP1 got hit. Boom. This could be TP2, right? TP just means take profit, by the way. That means when price hits my take profit, I'm selling my contracts and I'm securing my money. And we could target that, right? And look at this trade, guys. It was fucking beautiful. Not a second of drawdown. We didn't see any red. We enter, boom, first take profit got hit. Little pullback to a equilibrium, fair value gap. Boom, second, third TP got hit. Beautiful moves, right? Because we identified sweep, break, pullback. Sweep, inverse, pullback. Guys, this is how the market moves. Nobody can change my mind. Y'all can't if you tried. This is how the market moves. It's a fact, right? Still an option. So I could sell some contracts and let it run if it keeps moving up, down. Don't the colors have to be the same color? No, that is a common misconception. The colors do not have to be the same color, right? As long as there's a gap, guys. Let's try to find some examples, right? Do you guys see a gap anywhere in this price range? No, because there's no displacement. Now, as soon as we get some displacement, now there's a gap, right? Let me try to find an example of a gap with different colors. Okay, well, right here. Right here, perfect example. Okay, we have blue, blue, white. Not all the same color. Blue, blue, white. But guess what? The first candle And the second candle, and the third one, I'm sorry, first candle and third candle, the wicks do not touch. They do not touch. So even though they're different colors, this is still a gap. And what happened? We made the gap. We pulled back right here into the gap, right? Rebalanced to it. And what? We went higher. Where? To the next draw on liquidity right here, right? This is how the market moves. I understand it can be confusing, especially switching up the time frames, but please tell me you guys understand at least 1% more than you did before, right? Please tell me that this is making some type of sense, right? We sweep liquidity, boom, sweep, break, pull back. And you don't have to guess, oh, where are we going to pull back to? Fair value gaps. Oh, what are we going to target? Liquidity. There is an answer for everything, guys. You guys just got to take some time to lock in. Find a good mentor. Find someone who really cares about you, bro. Half of you guys are throwing money at people who don't give a fuck about your well-being, right? Real shit. And it's not about the money. It's just about the fact that we're trying to level up here. We're all trying to elevate. And there's people out here who don't give a fuck about you, right? Really figure out who your mentor is. Find someone with good intentions, because I see so many people get scammed by people who have no idea what the fuck they're talking about. And it genuinely just makes me mad, bro. Because this shit is not, trading is not my passion, guys. My passion is teaching. On some real shit. I learned trading because I had to get out of a sticky situation. I learned trading because I grew up broke. I had no family. I had bills to pay and I was struggling, right? But my passion is teaching. I love to teach, right? I'm here to teach you guys. Any questions you guys have, I want you to hit me up. Hit my line, DM me, call me. I don't give a fuck, right? I'm here to let you guys know, like, we are all growing and elevating together. Like, I really do this shit, guys. I have receipts, I got proof, I got bank statements, I got whatever y'all need if you don't believe me. I really do this. I really put in the time, and this is how the market moves. This is facts. I want you guys to study liquidity. I want you guys to study imbalances. I want you guys to study fair value gaps and inverse fair value gaps, right? When we disrespect it. Study market structure, right? Higher highs, trends. Figure out the trend. Okay, are we in an uptrend? If we're in an uptrend, then you want to mark out liquidity. You want to mark out your fair value gaps. Okay, are we inversing gaps? They should always be going in favor of your bias. If you expect price to go higher, okay, well, you want to look for bearish gaps to get ran through. You want to look for bullish gaps to get respected. You want to look for lows to get swept, right? Let's make a little list real quick, guys. Let's make a little list, okay? Real quick, if I want price to go lower, I want to see highs get swept, lows get broken through. I want to see bullish gaps get ran through. I want to see bearish gaps get respected. Okay, this is what I'm looking for, because this is confirming my bias. If I want price to go lower, this is what I want to see. Okay, and it is the exact opposite if I want price to go higher. I want to see lows get swept, right? It's the opposite. I want to see highs get broken through. I want to see bearish gaps get ran. And bullish gaps get respected, okay? This is what we should be looking for. Someone take a screenshot of this, put it in the chat, right? This is what we need to be seeing, guys. We need to have a plan. When I say, guys, plan your trade and trade your plan, this is what I mean. Establish a bias, understand what to look for, and when the market gives it to you, you just enter. It's that simple. Too many of you guys are just get caught up with the idea, with the notion of making money, right? Bro, that's crazy. That whole checklist are my exact confluences. Exactly, bro. Because this is how the market moves. It's not rocket, like, it's just facts. Just use IFVG. Let's fucking go, Ian. You're a fucking goat. Make sense. You're a blessing. Let's fucking go, guys. Dylan the Professor. Ya tu sabes. You already know, twin. No emotion, just motion. That's hard, bro. No emotion, just motion, bro. Real shit. Eddie was good. Andrew was good. Guys, this class is recorded, by the way, so I'm going to post it later on. Yeah. What's goody, twin? No motion, just motion. That's hard as fuck. Not going to cap, bro. Yeah, we using that, man. We using that. I ain't gonna lie. Ian, write that shit down, boy. We using that. But write that shit down. No trademark, real shit. I need that. Hey, use that for the official slogan. I'm about to. Dylan taking over 2025. No cap. Dylan for the people, man. I am for the people, guys. We are about to go so fucking stupid this year, right? With that being said, man, Does anybody have any questions? With all that being said, we covered a lot of the basics. Yes, sir. Ski. Any last clinic? If you guys had a question throughout the whole presentation and you wrote it down, anything, life, trading, something I mentioned before, something I didn't mention at all, whatever. Now's your time, guys. Ask questions. All right, we covered basically everything, all the important stuff. Of course, there's more like psychology. Of course, there's more like SMTs and low time frame manipulation. What's next class going to look like? Are you going over SMT? Nah, I'm not going to go over SMT. It's a little bit more complicated, and I didn't start using it until about 6 months ago, right? I was profitable even before I knew what the fuck it was, before I even used it. So you don't need it, but it definitely helps. What will tomorrow look like? I'm still trying to figure my shit out, guys. I have to go to the DMV tomorrow for my real ID because I'm going to Miami in 2 weeks, right? I need my real ID, and the only appointment was at 10 a.m. So unfortunately, I don't think I could trade tomorrow, which fucking hurts my heart, bro. I want to trade with y'all so damn bad, but I have to get this damn ID shit because I'm going to Miami, and I'm going with a bunch of traders, guys. The content is about to be stupid, stupid. But yo, I'm gonna stop the live. I'm gonna stop the recording. I want to turn my camera.